and welcome to the WARR HUNT Investment Series update. My name is Sam Hunt, and today I'm joined by independent member of the Investment Committee, Steve Garth. Welcome, Steve.
Thank you, Sam.
We thought this little video that we would put together would give you an overview or a flavour as to how we approach or how we think about emerging markets. When we're constructing portfolios for clients, there's sort of an asset allocation decision that's made between growth assets being equities and defensive being cash and fixed interest. And when we're talking about equities, that's highly diversified between Australia and international markets, but a component of those portfolios is also invested in emerging markets. So we thought it might be worthwhile, Steve, just getting your thoughts about how emerging markets are defined and the types of countries that might be included in an emerging markets component within the portfolios that we're managing.
Yeah, thanks, Sam. So the emerging markets as an investment class have been around really since the mid-70s, and emerging markets now make up about 12% of the global investable universe. So they're a fairly big part, and the biggest part of the emerging markets, which won't surprise anyone, is countries like China, Taiwan, and Korea, and then India and Russia.
Maybe to that point, like how do you define emerging markets? So is there a degree of government regulation, transparency within that particular country and their stock exchange that you'd then be happy to put it in an emerging market context? Because obviously you need to be able to trade to get in or out. And at what point, or what's the tipping point for, and you mentioned China, for it to become a developed nation and into that more global index?
Yeah, you really summed it up then, Sam. It is all based on around the regulation, and a big company called MSCI, which put together what they call the indices, an emerging market indice or a developed market indice. They have a team of people that are looking at the regulations and the stock exchanges of these different markets, and they're really making that call in consultation with the rest of the investment community about who is in the emerging markets and who is in the developed markets. So there's a lot of talk recently about China and Korea and Taiwan in various stages moving from emerging markets to developed market status. To be fair, it's a bit of a grey line.
Right.
So the MSCI make this decision again in consultation, but it's not a clear line.
Is why have a segment towards or an allocation towards emerging markets as a sort of a separate asset class?
Yeah, so a couple of reasons there, Sam. First one is over the long run, emerging markets have done a little bit better than developed markets, but it comes with a slightly higher volatility, and that sort of makes sense. You think about some of the additional risks that you might have in the emerging markets, such as political unrest. The emerging markets work quite differently to the equity markets. In other words, the emerging markets can do well while developed markets are not doing so well, and the reverse is true.
Terrific. Well, thank you for that short update on emerging markets, and we look forward to catching up with you again soon. Cheers.
Terrific. Thanks, Sam. Bye-bye.